You'll sometimes see investors' eyes just light up at the idea of a stock split. That's a way to make big money, right? Not necessarily. Here's a split that happened just the other day. Super Micro Computer did a 10-for-1 split. Investors like stock splits because they believe that with a lower price, you can load up on a lot more shares and, for some reason, make a lot more money. But let's look at that carefully. When a company does a stock split, yeah, it increases the number of shares available, but the value of each share is reduced. Here's how that works. Supermicro was trading at $4.16 before the split. Now, after the 10-for-1 split, the price dropped to $41.60, but shareholders got 10 shares for every one they owned before. So even though you now own more shares, your overall investment value hasn't changed, right? You don't just suddenly make more money. It's the same pie cut into smaller pieces. And there's something else a lot of people miss. The tradable float, which is the number of shares that you have available for trading, that doesn't change the company's value or your ownership stake. You have more shares at a lower price, but no extra value. So why do companies even do stock splits? It's really about optics and accessibility. A lower share price makes the stock seem more attractive to retail investors who like to get in at a lower price. Institutions don't care about that quite so much. It also boosts the liquidity, meaning more shares being bought and sold, making it easier to trade. And for stocks that have options, like Supermicro, we're looking at the options chain right here, splits can make contracts cheaper. But none of that means the stock is suddenly going to rocket higher after a split. Yes, there is sometimes some short-term excitement. People buy in. The stock may rise temporarily, but generally that effect doesn't really last. Right here you can see Supermicro has not done very much since its split. It's kind of been trading in that little sideways pattern. We can also look at a higher quality, less volatile stock. Apple last split in August of 2020, splitting 4-for-1. It went up initially, but pulled back, and a year later was up 31%, which is a little below its average 12-month gain of 38%. In other words, stock splits aren't some magical ticket to big money gains. And think about it. Sure, it's wonderful and tempting to think that there's some shortcut to making money in the market, some trick that nobody else knows about. But don't you think if that trick was really successful all the time, that everybody would know about it? There's no secrets. So next time you hear about a stock split, just remember, doesn't change the value of the company, doesn't change your ownership stake, and is not generally a way to make eye-popping gains in a stock.